Well, we seem to have had a war sort of get paid attention to in markets, but apparently we're back to their usual scheduled programming here. This is Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live, and we're looking at the week ahead here when at the start of this week, it would seem all of last week's worries have unclenched, at least as far as the markets are concerned, certainly not as far as the conflict now raging in the Middle East would have it. But the market's apparently not terribly bothered by what's going on. And we're going to take a look here at what might be the next thing to care about as the week proceeds, because it certainly doesn't seem to be missiles flying between Israel and Iran. And so we begin this week with a familiar kind of story. And it's probably the right thing that we are, because if we look at where, for example, the S&P 500 is, it has recovered from Friday's sell-off, but not so much that it's run away beyond where it was left with last week's update on the Federal Reserve, and that was relatively benign U.S. CPI and U.S. PPI data. So the idea that the tariffs haven't as yet created the inflationary run-up that the Fed is so concerned about, that's the last thing that the markets are seemingly prepared to care about, having brushed off Friday's scare. So we'll start here with a look at the performance readings for last week, and needless to say, this is quite a bit skewed by Friday's action. So you can see on the week, we have modest losses for the major stock indexes. Yields are down as bonds find a haven bid. Crude oil prices up 13% on the week, which, needless to say, happens basically in 24 hours. Gold is up. The dollar is weaker against both the euro and the yen. And the story on display seemingly focused very much on what happened from Thursday to Friday with Israel's move to strike at Iran's nuclear program. About the only place where that isn't readily on display is, in fact, the dollar. You might expect that the dollar would do well in a risk-off environment. It does tend to have these kind of typical risk-off haven characteristics. And of course, its unrivaled liquidity as the cash of choice for global commerce. That's first and foremost. When people cash out because they're afraid, where do they cash out into? Mainly the dollar. And so when you look at then what seems to be going on here, the part that doesn't line up with everything else is this bit, this dollar aspect of the story. Because you do see that the dollar is a little bit weaker, and it was even weaker when you consider what's going on here. And by the way, that's supposed to say the week of June 9th, not the week of June 2nd. Sorry about that. But you don't see the dollar catch that haven bid, and much of that really seems to speak to the inflation data that you saw, and that inflation data being supportive of Fed rate cuts. And so as we change gears and as the markets reset back to where that inflation data left us, sort of have to ask the question, is the currency market, obviously because it is cash, overwhelmingly more liquid than pretty much anything else, is that telling us something here? Is that suggesting a path of least resistance? And with that, we'll take a look at a range of data outcomes this week. We start off relatively light with U.S. retail sales data tomorrow. Expectation is for a 0.7% decline in sales month on month. That's after we essentially got a flat result in April, 0.1% rise, basically almost zero. We saw a good bit of front running of the tariffs as the catalyst for rising sales in March at 1.7%, but very pointedly in April, that did not continue. And the expectation here is that consumers are going to be still defensive going into May. Now, what's interesting about this, of course, is that we just had U.S. consumer confidence numbers come out on Friday, not that anyone would notice with the Middle Eastern war at the front of the headlines, but it turned out that this consumer confidence report was actually much better than anticipated. A very significant upshift in consumer confidence, largely linked, not surprisingly, to a significant move lower in one-year inflation expectations. At one point, we can see here in April and in March, inflation expectations, or in April and in May rather, inflation expectations were north of where the peak was during COVID. And now, of course, we can see that we've come all the way back down and indeed inside that peak. So things appear to be normalizing. People appear to be less worried about inflation coming from the tariffs, at least for now. And so the story seems to be that this was perhaps a reason to expect that maybe this surprised on the upside, or at least maybe it wasn't as bad as these expectations suggest. And of course, the reason this is so important is because aside from all of this noise in first quarter GDP data around a brutal surge in imports, a massive surge in inventories as clocked inside the investment component of GDP. All of that aside, as a kind of episodic front-running of incoming tariffs, people trying to stock up their inventories as much as they possibly can before any would-be increase in tariffs materializes. This is first quarter GDP, after all, through March. So at that point, the markets hadn't seen Liberation Day yet. All of that noise aside, the real takeaway was that the increase from consumption was the weakest that it had been since the second quarter of 2023, so almost a two-year low in consumption. And, of course, that's the important part of GDP, accounting for 68.5% of the whole thing. Whereas what's going on in the export and import story is barely an afterthought. We can see here there's exports and there's imports. We can see imports are narrowly higher. Once you net them out in their contribution to GDP, because we can see exports detract and exports add, we end up with barely 5% of the total. Needless to say, consumption is a much, much bigger deal. And so if consumer confidence is improving and we see retail sales better than expected, well, that would tell us a story about the resilience of growth. And if we don't see that, if, like in April, consumption is weak despite the fact that tariff-induced goods inflation hasn't really materialized at the consumer level, well, then that would suggest that something much more ominous is in fact afoot. With that in mind, we go to the almost certainly biggest risk on the economic calendar, and that's the Fed monetary policy announcement. No changes in the headline rate range expected, of course. We can see here very clearly standstill in June, standstill in July. We start to edge a little bit in the direction of cuts come September. We can see the cut is pretty much fully priced in by October, and then we're looking at another one likely in December. So if we take the entire calculus here, we can see the markets are just shy of pricing in the full 50 basis points in cuts, 42 basis points on the menu for this year currently. So that basically tells you that you have one 25 basis point cut all the way priced in, and then 17 basis points along the way to the next one, which amounts to a 68% probability that you get that second cut. And that's not dissimilar from where Fed policy expectations themselves are sitting. In fact, you can see the tally here for both 2025 and 2026, 99 basis points. So, but for a bit of rounding, exactly what the Fed had in mind. Here's the March update of the summary of economic projections, where you can see we're expected to go from 4.4, which is the average current rate. See that right here. Of course, the Fed sets its rates in a range from 4.5 to 4.25 currently, but this is the median. And so from 4.4 to 3.9, that's 50 basis points, and to 3.4 the following year, that's another 50 basis points. So from 4.4 to 3.4, 100 basis points between now and the end of 2026. And again, market pricing is about there. But whereas the Fed is equal weighted, you can see here the markets are increasingly anchoring to where rates will be this year, but extrapolating out more easing into next year. So we have 42 and 57 as the split, with the bias seemingly that the Fed is going to be late. It's going to wait longer to cut, and you might end up in a place where they only manage to squeeze one out this year. And so you have more scope for easing next year. In other words, the markets are expecting the Fed to be biased towards standstill near term, and to pay for that with more aggressive easing later. Now, if we look at what the Fed last told us in May, we can see that the upshot here is continued worries about uncertainty. In fact, we can see the Fed here saying that although swings in net exports have affected the data, indicators suggest economic activity has continued at a solid pace. In other words, the economy is broadly okay. Unemployment is broadly at a normal level. Inflation is at an acceptable level given the circumstances. And of course, the most recent data last week suggested it's more benign than expected. But we can see that uncertainty about the economic outlook has increased further as of May, and risks to both unemployment and inflation have risen. We see that show up in the minutes from that meeting. Uncertainty features very loudly into these comments. Worries about having difficult trade-offs, because, of course, lower inflation would beckon rate cuts. But in this environment, we're looking at risks for higher inflation and higher unemployment, where the higher inflation would argue for, at worst, standstill, if not hikes, and higher unemployment would argue for sticking with the cuts idea and maybe even dialing it up. And of course, that leaves the Fed somewhat paralyzed. And so what we have here then is the makings of a very market relevant disconnect. Because while the Fed seems to be talking up uncertainty and saying we're not going anywhere fast, and of course that calculus hasn't changed between May and June, the Fed still faces all of the same uncertainty. The growth story hasn't really changed. Neither has inflation or unemployment in the kind of way that the Fed would care about. No major swings. And there are still cliffhangers as to the 90-day pauses in reciprocal tariffs. One coming up for most countries ex-China in July, one coming up for China in early August. All of these things leave the Fed in basically the same mode as they were in March, as they were in May, throwing up their hands and saying, we don't know what all of this means until we do. But the markets seem to have decided. You can see here that when the tariffs implementation was a growth scare at the beginning of the year, benchmark inflation expectations fell with stocks, the S&P 500 here in yellow, and it's the 5 and 10 year break-evens in the blue and red here. Those are the inflation expectations implied in bond markets. When this was a growth scare, not surprisingly, they moved together. Stocks have rebounded clearly, but inflation expectations remain anchored, as if to say the Fed doesn't need to be worried about inflation. What it needs to be worried about is growth, because that's what the risk is on the table. And so if the Fed does nothing and signals nothing and ultimately leaves markets with another vague, we don't know, wait and see kind of a message, at a time when the markets have increasingly decided what the message ought to be, well, that might leave them disappointed. And that's a potential risk for stocks. It may shift bonds higher as more rate cuts go into the long end of the curve. It may likewise weigh on the dollar and boost gold as that rate cut speculation starts to bubble. Now, after the focus on the Fed, we shift gears across the Atlantic to the UK, where there's some data of note as well as a policy announcement. We start with UK CPI. It is expected to dip a little bit after the surge in the previous month's data, in April's data. That was a 15-month high on headline CPI at 3.5%. We're expected to come in a little bit here to 3.4. Headline reading, the core expected to come in as well, down to 3.6%. If we look at the way that inflation was breaking down in April, we can see that there was a huge one-off increase to the price of fuel, which really represents some policy changes, new excise tax and a bunch of other kind of one-off elements. And you can see the knock-on effect from the change in the cost of fuel down to the cost of transport. And so you have that as the main kind of catalyst for a large increase, but these things should begin to fade over time. And the Bank of England is, at the very least, minded probably to stay steady here while that happens. We can see that the expectation is indeed that we remain on hold at this month's meeting, although we start to increasingly look at another cut between April and September somewhere as you get these influences waning and inflation expectations start to shed the risk of building out and anchoring. And so then you once again get the scope for rate cuts. And we can see here the expectation is that we're going to get 45 basis points yet this year and another 22 basis points next year. So altogether, you're looking at 68 basis points cumulatively. So almost 3 rate cuts on the menu, at least 2. So at least 1 this year and 1 next year. But the bias for this year to 2 1/3 in 2026. So that'll be interesting to track what the Bank of England says here. And most importantly, since the UK is the only country that's so far signed any kind of a trade deal with the US, how that echoes in their conversation. Are we going to have, for example, a Bank of England that says, well, now that we have a tariff deal, we don't really think about this. We have a benchmark, and we expect that benchmark to hold. Or if the Bank of England comes out and says, well, the global growth story is still so shaky and still so uncertain that we're really not going to make a call here, and we're not going to say that we know what's going on. We're going to use an abundance of caution with some of these one-off inflationary jumps and make sure they don't get out of hand and settle in an orderly fashion. So we're holding rates, but that's not because we are necessarily convinced that our easing cycle is over. Not, for example, like what we heard from the ECB, where the signaling was that although the easing cycle continues, it is almost at its end. And so this should be an interesting story to get the perspective on what the knock-on effects from the tariffs are, not just for the global economy, but also for a country that ostensibly has already addressed the issue, and how its central bank is going to think about next steps. Ostensibly, the upshot here is if inflation in the UK is indeed temporary and the Bank of England is no more hawkish, then you'd be entering a situation where perhaps the Bank of England's tone might make the British pound somewhat vulnerable. But we have seen, as we just said at the start of the show, a reluctance for the US dollar to make progress against its major counterparts. And this would be another test of its mettle. As ever for the Bank of England, there's a 9-person committee, 1 person, 1 vote. So to figure out where the central bank is leaning, looking at the makeup of the voting is very instructive. Last time they voted 7-2 to cut. This time they're expected again to vote 7-2, but to hold. And if the consensus to hold becomes any firmer than that, or less firm, if it's more like 6-3 or 8-1 or even 9-0, well, then you'd get a sense that maybe the Bank of England is more hawkish or less relative to market forecasts. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm likewise on with Victor Jones for the Price of Truth on Tuesdays, on with Chris for Futures Power Hour Mondays and Fridays, writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.